Hello, and welcome to Spotlight On, the podcast that brings together business leaders, entrepreneurs, and experts covering a range of topics. I'm Nicholas Barton, founder and CEO of the Barton Partnership. We're an award-winning executive recruitment and consulting solutions firm providing permanent search and independent consulting services across strategy, sustainability and M&A, data and analytics, and transformation and change. Today, I've got the great pleasure of being joined by Suvir Varma. Suvir hosts a portfolio of non-executive roles and remains an advisory partner of Bain & Company, advising private equity firms on select client work and the firm's balance sheet-related M&A activities across APAC. Suvir was formerly head of Bain's APAC private equity and sovereign wealth fund practice and a member of Bain's Global Investment Committee. In addition to Bain, he is chairman of Asia for Campbell's Lutyens and sits on the advisory board of several PE firms in the region. So Suvir, it's great to have you with us today. Thank you for joining me. Given your role at Bain now, it'd be great to get your insight on the topics that we're going to be talking about today. But let's start at the beginning, perhaps by sharing a quick overview of your career journey from your time at Bain and your charity work with Love Nils and your board advisory roles. Just give me a snapshot of your life to this point.
Thanks, Nick. Delighted to be here to support the Barton Partnership. And let me tell you a little bit about myself. So I started off life as an investment banker in the US, spent a couple of years there and a third year in Hong Kong. I went back to business school. I made the transition through my business school experience in Chicago over to management consulting. Now I'm coming on, close to 30 years or so. I joined consulting in 96, so I guess 28 years to be precise, in the management consulting industry. Early in my consulting career, like many, I was sort of a generalist and worked across a number of different industries and across the Asia-Pacific region. But quite early in my career, as I was getting up to partner and then as a new partner, I started to focus on financial investors. So industry agnostic, but on private equity, sovereign wealth funds, corporates, as they were looking to do deals, extract value from those deals, and things of that nature. I was blessed to have a great career at Bain, focused on that lane, if you like, was running the firm's Asia-Pacific private equity advisory business, had a number of governance roles in the firm, also sat on the firm's Global Investment Committee, and then in 2018, moved to my current model, which was Bain part-time, with the rest of my career being a plural career with non-executive roles outside of Bain. So while I remain an advisory partner at Bain today, I also have a number of external roles, which include being the chairman for Asia of a private capital advisor, one of the top in the world, called Campbell's Lutyens. I sit on a number of private equity firm global advisory boards. And as you alluded to in your intro, I also am involved with a pediatric cancer charity in Singapore. So I believe at this stage of my life, this gives me, the right balance, intellectual challenge, stimulation, ability to make impact, and of course, some financial rewards as well.
Is balance such a thing at the moment with everything going on? That sounds like you are spinning a lot of plates.
I guess balance is all what it means to you. I still work a lot of hours in a day. Some people might consider that imbalanced, but I have a lot of control over what I do. I spend my hours doing things that I really enjoy, with the exception of certain board meetings or public company roles and so on. I can do my work for the most part from wherever I am, as long as I'm fulfilling my duties. And so all of those things provide balance to me.
Well, listen, I'm glad to hear that. Well, it's on the back of another good friend of ours, Graham Elton, who I did a podcast with earlier in the year. We talked about sort of the private equity world, I guess, from an EMEA point of view. Really excited to get your perspective on the Asia-Pacific world. So let's start with the first question. And obviously, the big topic at the moment is AI, right? And as AI continues to evolve, how has its use in private equity advanced? How has Bain been using it both internally and with clients? How have you adopted and how have you seen private equity adopt AI in Asia Pacific?
So first of all, don't compare me to the beautiful interview that you had with Graham. He knows far more about this topic than I do. He's a big friend, as you said. But as he alluded to in the case of EMEA, I mean, AI is definitely an important, very important component in the world of private equity right now. Let me start with it a client lens and what we're seeing them do. And I'll kind of break it down into four different categories. First of all, is obviously clients are using it a fair deal in what I'll call their strategies, their where to compete lens. It's helping them do things like sector point of views or thinking through where strategically their firm might focus on finding deals based on the use of AI technologies. Two is obviously, as you expect, there are lots of tools and techniques now that can be leveraged in the AI world in due diligence, in your classic diligence of a company. Three, and this is probably in APAC where we're seeing the greatest focus from PE player standpoint, is then in the portfolio. So both in terms of where disruption can come, but also where opportunities may lie by leveraging AI. So we're seeing an immense, frankly, as portfolio companies are being held a little bit longer, more juice to be had, so to speak. So AI is playing a critical role there. And then last but not least is just in the running of a PE firm. You can call it in the operations of the firm. There are efficiencies to be gained by leveraging AI across many of the functional components of what a firm does. So quite a broad set of adaptations. Of course, its application in each firm is a little bit different, but I think it's universally being adopted. Internally at Bain, it's also a significant focus, as you'd imagine, advising clients and doing this. You've also got to be leveraging yourself to be discussing it as a principal and as an advisor. And tremendous tools, benefits we're seeing from the quality and efficiency of analysis that we can now do using AI. I mean, just to give you one tangible example, in the old world of consulting to private equity, one might spend a good number of days at the start of a diligence, painstakingly designing survey questions that will be used for a B2B audience or a B2C audience, and go back and forth on all the different iterations of what the right questions will be. In a matter of minutes, frankly, with the right setup, and AI, leveraging AI can probably get you a 70 to 80% version of what that base survey needs to look like. Of course, you're going to adjust it and perfect it based on the experience of the senior people on the team and exactly what the client investment thesis is. But you get, as I said, you get a pretty good draft of that much quicker than you would before. So that's just a very tangible example of how AI is being used in our core business.
Let's talk about then the increasing focus on sustainable investments as well. This was highlighted in Bain's Asia Pacific Private Equity report this year. How has the shift towards defensive assets like manufacturing and energy transition related firms influenced APAC's private equity deal trends?
Interesting. Well, first of all, I'm glad to see, Nick, that you read our APAC private equity report. You're absolutely right. Look, in a muted deal market in 2023, sustainable investing or energy transition, if I can call it that, was really a bright spot. If I'm not mistaken, the count was up something like 50% on the last 5-year average of deals in that sector. Within that, really, deals focused on climate investing are up incredibly strongly. And if I break that down into sub-asset class, it's across both what you might call traditional infra deals as well as PE deals. And it's up and downstream. It's very, very broad. So it could be component manufacturing of what's going into the technology complex of climate investing. It could be the financing elements of financial services. It could be software tools. It could be technical services. So there's a whole broad range of climate investing themes that we're seeing. The trends are incredibly positive, but I think just to put it in perspective, in APAC, it's still quite nascent. I mean, we saw maybe 200 deals or so across the region, all of APAC last year in this space. So it's still a small part of the industry writ large, but it is growing quite substantially.
How can APAC firms adapt their investment strategies to capitalize on this? I mean, how central is this in boardroom discussions right now?
Look, it's a very, very critical topic in boardroom discussions. I think it's going to be hard to find a financial investor, be it an LP classic allocator, an LP or a GP, a PE fund, that is not thinking about how they play energy transition and how they think about their own commitments Obviously, part of helping firms define and meet their climate-related commitments is a critical part of what a lot of advisors and Bain is doing in the region. The where to play is, of course, different across these firms, and there's a whole bunch of interesting themes that they're pursuing. Just to sort of name a few, there's the sort of gray to green transition and scale up of engine 2 businesses for some of the traditional energy players. There are essential components businesses that facilitate this transition journey. There are essential services. I touched on funding, but things like certification and so on, these are all enablers to the transition journey. And then, of course, there's a plethora of digital tools focused on things like monitoring and so on. So I think while the boardroom agenda focus is omnipresent, the where to play is somewhat different across different firms.
It's interesting, isn't it? Because obviously there's a lot of dynamic plays that are taking place at the moment across the region. I mean, obviously with China's economic slowdown and the broad sort of cautious investment climate that we're experiencing in APAC right now, what opportunities do you see for investors looking to capitalize on potential recovery opportunities? And what sort of timeline do you see that turning for the market in APAC?
That's a great question. I mean, the reality is we got to the point where China, given its economic mass and stature and growth rate, was above 50% of the private equity business in APAC, right? So it became a very substantial part of the market. And as you correctly pointed out, that's a very tough segment to be in right now, whether it's driven by the slowdown in the Chinese economy, whether it's geopolitical tensions or what have you. But certainly we've seen quite a decrease in China activity. Look, there's lots of different green shoots, and there are lots of different ways to potentially play that. First of all, it's at a sectoral level. So things like automotive, particularly driven by the EV sector, parts of the semiconductor value chain. So there are some defensive industries, healthcare, for example, where there is more resilience than there is in others. There's types of deals. So we're seeing a greater focus on control deals, so less growth and more control. We're seeing focus on cross-border. We're seeing M&A bolt-ons. We're seeing MNC carve-outs as some MNCs decide what presence they're going to have in China, and maybe some non-core units are being jettisoned and are available for purchase at historic valuation lows. So for those who take a long-term view, because the reality is China will be back, and I can't tell you exactly when they'll be back, but it's too big an economy, it's too many people, very important part of global trade in the years to come. When it comes back, a lot of these things will be a lot more attractive again. So there is opportunity to be had. Patient capital will go in earlier. Maybe 10-year oriented funds or dollar investors might wait a little bit because of the concerns we alluded to. But I think the long-term view is that China will be back, and will be back in a big way.
And what about Japan then? Obviously, they've experienced significant growth in deal value, certainly in 23. Are they one of the shining lights in the region right now? Do they continue to prosper and drive the economy in that region?
Look, absolutely. I mean, the reality is Japan's always been a mega economy. It's just that its private equity market has lagged the scale of its broad economic heft. And that's finally changing. Over the last couple of years, it's become the largest PE market in Asia. I think just north of 30% of aggregate deal value for the region. And there are lots of different thematics, if you like, that are happening in Japan to drive this PE boom. Take privates, there's succession issues, turnaround plays, there's carve-outs from Japanese large karetsus, and there's a tremendous amount of domestic capital coming into the asset class beyond some of the global funds investing in the market. One other broad challenge for the asset class in Asia has been DPI or liquidity, and Japan, in contrast, has seen a good number of exits, both strategics and through some IPOs and so on. So we are seeing recycling of capital. So I'd say, for those who have a clear basis of differentiation and a thesis, Japan is very attractive right now.
As the entire APAC market becomes increasingly fragmented, how are private equity funds adapting their value creation strategies and structuring their portfolio management teams to be effective across diverse environments?
First of all, agree with the broad sentiment that value creation strategies are now more important than ever. That alluded to in our APAC private equity report and in our global private equity report. There isn't a one-size-fits-all strategy for adding value into portfolios. And it's really dependent on the fund's DNA, modus operandi, how interventionist, if I can call it that, they want to be. We have some clients that take a rather ad hoc approach. They buy with a clear thesis. They leave it to the management teams to execute that thesis. They get involved sparingly. We have others who are very focused up front, what I'd call a real value creation plan for the holding period, 100-day plan, however you want to refer to it. But they go in on these are the few drivers of value, and they and their teams really focus on ensuring that delivery happens on those values based on a plan that's set early on. Of course, one can tweak it along the way, but that's sort of the blueprint that they're working towards. We have others who believe that once the strategy is set, they're going to focus a lot on functional full potential. So finance levers, HR, procurement, cost management, but they bring in functional experts, either third party or within their firm. Some focus on doing all this through the board. So they might retain advisors or put in people on the board or use consultants like us. But the point is, you can decide what strategy works for your fund. There isn't virtually anybody who's just buying and doing nothing, because the last decade of reliance on multiple expansion and a bit of leverage if you could get it and so on and so forth, I think those levers are going to be far less drivers of attribution going forward. And it's going to be much more on just good old-fashioned improving the quality of the business, growing revenues, driving margins, and that requires a real value creation focus.
Finally, let's talk about 2025. From your board advisory experience, what trends or shift do you see shaping the APAC private equity sector as we move into next year? And how should firms prepare for them? And are you optimistic that we will see a stronger economy in 25 than we have seen this year?
The reality is, Nick, the asset class, private capital that is still significantly underpenetrated in the APAC region on any measure you use compared to OECD economies. So I have full faith that PE, private debt, infra, these asset classes will still continue to grow across the APAC region. The challenge, as you alluded to, is the short-term prognosis is quite varied across different markets, and that's driven by a couple of things, some that are in control and some that are not in control. Not in control, denominator effect of large global LPs and feeling the squeeze on their allocations in private equity. In control, the lack of distributable, DPI back from investments in Asia. But these will clear. I mean, the market will clear these things in time. 2025 is going to look better. I can't tell you whether it's going to get back to the peaks that we saw, in 21 and so on, because a couple of things. One, I think the firms have figured out that they need to have a clear thesis behind which to invest. I think two, per your question earlier, firms are focusing on adding value to deals, so having a clear value creation model. In some cases, they realize that you've got to make early decisions on people, and that's starting to take hold across some funds in the region. They're quite focused, and their LPs are making sure they're quite focused on strategy and avoiding what I'll call strategy drift. So real sticking to the core of what was their knitting. And last but not least is it has to translate into a maniacal focus and results on exits and DPI, because ultimately this is an asset class that thrives on the recycling of capital. So in Asia now, we've got a huge stock of companies that have been invested in, many of which are held more than 5-6 years. They need to get exited, and that will support the virtuous wheel turning again. So I think 25 will be better than 24, but it's frankly going to take a couple of years for the whole cycle to become virtuous again, because we have a large stock of deals held in the region. And also because, as we talked about, China was a significant portion of the industry, and I don't think that solves itself in the short term. Long term, on private equity in APAC, absolutely, it's going to be onwards and upwards from here.
Suvir, thanks again for joining us. Your insight has been fantastic. Look forward to sharing that with our market as well. Love the fact that you're very positive about private equity in Asia Pacific going forward, which I'm sure will give a lot of comfort to a lot of people listening to this. Thank you.